When did you realize that investments are your calling?
Just sort of being part of that platform and just sort of discussing different ideas with some of the seniors, I think that sort of gave me a lot of early exposure and understanding.
For somebody who's new to investing and wants to pick that right stock for them, it's literally like finding a needle in a haystack, right? Because there's just so many out there.
You see, for example, like a company's earnings growth is good. It's corrected by 30-40%. And valuations are reasonable. Maybe it's a good time for you to look at that company or buy into it.
What would your favorite investment style be?
We are growth investors, so we essentially look for quality companies which are growing at decent pace, but for a long period of time and available at reasonable valuations.
How do you diversify risk?
So one is a portfolio approach.
Yes.
The other is in a portfolio sort of have cap on what weights you give to different sectors, different stocks.
We're going to talk about some trends and where you see the market is going in the future.
Now what has happened is the liquidity, number of participants in the markets have gone up quite a bit. So there's a lot of concurrent liquidity available.
People want to build their first startup when they're like 16 years old now. So what do you think about the startup culture and how do you think it'll shape the economy?
So over the last 10 years, this has become a very formal sort of an asset class almost in itself, with a full ecosystem of investors and entrepreneurs and mentors and all of that. So I'm sure like this will produce some outstanding startups and companies from India.
$10,000 crores. That's a massive number. It's incredible. Imagine if you had to manage that much money. That's exactly what our guest today does. He manages that as his AUM for his clients at Motilal Oswal. He got his MBA from London Business School. He started off his career at CRISIL as an analyst. He's the founder of Teji Mandi and he's worked his way up to becoming the CIO of PMS and AIF at Motilal Oswal. Please welcome Mr. Vaibhav Agarwal. Hi Vaibhav, welcome to the show.
Yeah, thanks Sayali. Pleasure to be here.
I'm so excited to get into this conversation.
Yes, absolutely.
I have wanted to ask you this since, we learnt about your profile.
Yeah.
A computer science degree is what you first had as a bachelor's. Then you went on to do your MBA.
Yeah.
How do you blend that technical skill and bring it to financial management?
So I think computer science sort of just gave me an appreciation for technology businesses. So while I studied that, I also studied engineering entrepreneurship in undergrad.
Oh, okay.
So that gave me an understanding of some of the engineering businesses and how some of the startups, etc. do. I also studied finance actually when I was in my undergrad as well. So blending that and then sort of I was able to come to CRISIL as a ratings analyst and then I came to Motilal Oswal as an asset management analyst. So I think because of that I got a fair exposure to finance. And I think having a technology background sort of obviously helped to sort of add another layer on top of it. So I think that's how I got into the stock market. Obviously I had some early exposure into this as well. So I think we were always very strong on the fundamental analysis side. I think over a period of time, obviously you get comfortable using technology.
Yeah.
So I think just maybe using some additional technology tools from an investing standpoint, I think that's what that undergrad helped me in. But beyond that, I think it was more appreciation for technology businesses.
Nice. And when did you realize that investments are your calling? Like this is the field for you?
So I think it was an iterative process over time because I started studying engineering at UPenn. And then every summer, actually, I would come back to India and do some internship in investing and all of that. So I think because maybe I had early success, maybe some early validation, and I figured like engineering, maybe like sort of not from a professional standpoint to get into it would have been a completely different ball game. I thought this was the field that made sense for me.
Nice. And tell us a little bit about your first steps. So when you started at Motilal and now that you're managing, like I said, 10,000 crores in AUM.
Yeah. So when I came in, I think, I'd already done a bunch of internships and all of that. So I had a reasonable amount of exposure. But when I came here, obviously I got to see how it happens live with the fund managers, the analysts, even mentorship of my father around. So I think just sort of being part of that platform and just sort of discussing different ideas with some of the seniors, I think that sort of gave me a lot of early exposure and understanding and sort of helped me shape up from there on.
Nice. Okay, so changing gears a little bit, I want to talk to you about a little bit on stock selection and market valuations. No, don't worry, I'm not going to ask you your favorite stocks because that's to each their own, I think. We all know that IPOs are a hot topic, right? And when you're going into the new season and you're looking for the next big thing, what would your top 3 things, let's say, when you're looking for a new IPO to invest in or to apply for?
So I would say that one is you should see the long-term track record of the company, how it's delivered in terms of earnings and various parameters. Then you also want to see what are the growth prospects of the industry from the next 3 to 5 year standpoint, and how the company is sort of placed to take advantage of that. And are they benefiting disproportionately from an earnings growth or margin growth, volume growth kind of standpoint. And last I would think is that if you have the ability to do channel checks, because nowadays there are a lot of forums through which you can do it, that also gives you additional insight into the companies and the promoters. So I think these are some things you should look at before you invest.
Can you dive into the channel checks a little bit for our layman investors who don't really know much about it?
Yeah, so I mean, I think it's like sort of in any industry there's a reasonably large ecosystem of suppliers, distributors, competitors. Some are listed, some are unlisted. So even just sort of maybe speaking to a few of them would give you a sense of how the company is placed and how it's likely to do. And some of them may be your acquaintances, maybe your friends or friends of friends. In some cases, you can just sort of set up meetings through LinkedIn or some of those other things. And for a little more serious practitioners, I mean, then there are agencies as well that help you to connect you to experts.
Fair.
Yeah. So it depends on sort of how deep you want to go into it.
Okay, and for somebody who's new to investing and wants to pick that right stock for them, it's literally like finding a needle in a haystack, right? Because there's just so many out there. So how do you go about doing that, finding the right stock for you?
So I think one of the easy things at least someone can do is like they can filter out companies which have a return on equity upwards of 15%, because at least these are companies that have shown good capital allocation, good returns on equity, and then you see how they've grown in the past, in the last 3 and 5 years, and how are they placed, like how are the benchmark valuations compared to the rest of their peers. I think that's a good place to start. I mean, obviously every company has its own different dynamic.
Yeah.
But if you listen to the earnings con calls, I think for most companies nowadays that's available.
Yeah.
If you listen to that, you'll figure out what are the main drivers of these companies. You can also see what some of the big investors are doing.
Yeah, that's a great one.
Because that's a good universe to scan from, or what some of the big funds are buying. At least for beginners, that's a good place to start.
Yeah. And a lot of times, I think the new investors, like you said, they're looking to kind of, find their footing, but they don't understand what we call market sentiment, right? There's a lot of behavioral finance that goes behind what the market is doing. Why suddenly it's up today, why suddenly it's down today. There's a lot of behavioral aspect to it. Do you look at the psychological aspects behind it while picking stocks, or is it kind of a secondary thing when you're analyzing stocks?
So I think what happens is, every stock has some relative valuation compared to its own historical mean or compared to the rest of the sector. So you have to see where it is. Is it trading 1 or 2 standard deviations below or 1 or 2 standard deviations above? If it's trading 1 or 2 standard deviations above, you know that maybe people are bullish on it. If it's 2 standard deviations below, you know people are negative on it. So I think that will give you, just looking at the standard deviation of the valuations, and I think there are a lot of publicly available tools that give you that. So I think if you use that and you see how is the history of, say, the price to earnings chart or price to book, that gives you a rough sense of sort of how the company is placed from a valuation standpoint. And oftentimes I think that becomes a good indicator of market sentiment.
Got it. And how do you maintain objectivity during this entire process? Because boss, it's finally, your money on the line. And a lot of times people get swayed by what's going on, and there's a certain amount of fear in the market. Everybody gets scared. There's panic. Sometimes there's euphoria. How do you maintain objectivity through all of that?
So I think, one is, so from an emotional standpoint, one is I think you you should not get emotional. I mean, I think that's easier said than done.
Yeah.
But I think when you're looking at it, you see things from a logical standpoint maybe, and then just sort of synthesize it. So if you see, for example, like a company's earnings growth is good, but it's corrected by 30-40%, and valuations are reasonable, maybe it's a good time for you to look at that company or buy into it.
Yeah.
I mean, I think it's not easy for everyone to be an extremely contrarian investor.
Yeah.
But when things correct from their highs, or something that's growing well is available at a reasonable valuation, I think that's definitely some time that people should buy into stocks.
Yeah. Like bad at a discount, right? Like that's what we hope for.
And usually, I don't think you should get into short-term volatility like 1 month or 3 months. But if you see things over a 6 to 12 month perspective, then a lot of the daily noise sort of goes out of the window.
Got it.
And you're able to sort of look at things from a more structural standpoint.
I agree. We're big fans of long-term investing, and we're not, we don't really propagate a lot of short-term vision or trading, just because it's not what we, I guess, vibe with. You mentioned market valuations, right? Now, that's a tough job. So what do you think should be the foundational things, some of the things that you should look at as a new investor when you're trying to value the company or trying to figure out whether it's valued right or not?
So I think in most cases, like I think almost every industry has a different sort of valuation metric, but usually for asset light industries, I think price to earnings, or in some, and you also see how the operating cash flow, etc. is working. The history of that and relative to the market, how that's doing. I think for novices, that's a good place to be in. And I think when there are asset heavy businesses, then you look at EV to EBITDA. Now not everyone may sort of agree with what I'm saying, but I think like doing a DCF valuation is not very easy, and it's also there are a lot of sensitivities you have to do. So I think for everyone to build such a comprehensive model, etc., may not always be straightforward.
Yeah.
So I think these are two ways in which at least you can get some sort of barometer to gauge if something is reasonably expensive or cheap or.
Yeah. No, absolutely. Building a DCF model is difficult. It's complex, and one little variable can literally change the entire thing, right? And you can justify it as long as your reasoning behind it is right.
Yeah.
So, and for, like I said, new or novice investors, building a DCF model is like, it's next level. So I think these are some great tips and tricks to kind of navigate that. Moving on to a little bit of a personal touch. You've grown up in the Motilal ecosystem, right? You've been around, you've had conversations on the dinner table, I'm sure, around it. What was that like?
So I think for me, I think conversations around this topic maybe started only when I was like 18, 19 years old. I think before that, I think it was, maybe more relevant to sort of what was there at that age around education or, what was relevant at that time. But I think it gave me an understanding of maybe how my father thought about things, and how he looked at investing, and how his own investment journey has evolved over a period of time, from value investing to growth investing. So I got to see I guess a little early exposure to the different styles of investing early on. But I think only when you actually start practicing it, you have your own maybe investment book. I think that's when you actually learn like what it really is, because like sort of one is just having intellectual discussions is one thing, but actually sort of practicing it
to wildly different things, right? To wildly different scenarios.
Yeah.
So what would your I guess favorite investment style be?
So see, we are growth investors,
and
our philosophy is the QGLP style of investing. So we essentially look for quality companies which are growing at decent pace but for a long period of time and available at reasonable valuations. So we are like the high quality, high growth camp of investing. And I think that's done well for us.
Nice. And we love to talk about failures on this podcast.
Sure.
Because yes, success teaches us one thing, but failures, we believe, teach us a lot more, right? Because we have so much to learn from them. Could you tell us a little bit throughout your journey, some missteps maybe, or some a few instances where you've learned a lot?
So I think one is, obviously companies give out their projections.
Yes.
And oftentimes, I mean, there are obviously a lot of things happening. But I think in one or two cases, didn't catch the signals early on. And then obviously we saw some correction in those companies. So that's why I think having a portfolio approach is very important, because if you're in the business of taking risk, and there will be one or two misses that you have. So when you have a portfolio and you sort of manage it, then even while you may go wrong, but if it's a well allocated portfolio, then generally this sort of gets taken care of by some of the other companies. So I think that's what I learned. One is like sort of relying too much on one individual stock to give you returns
Is not the best.
Is not a very replicable outcome.
Got it.
So for prop investors, maybe that's something they look at. But as public market investors, we have to deliver consistent outcomes over a period of time. So having that style may not sort of always work.
Got it. This answers my next question, which is going to be, how do you diversify risk?
So one is a portfolio approach.
Yes.
The other is, in a portfolio, sort of have weights on, like have a cap on what weights you give to different sectors, different stocks, trimming winners in the sense that to make sure it's within the weight limit. Otherwise, if they re-rate very fast, they can become a disproportionate part of your portfolio.
Of course.
Then the other thing is, if something's becoming a nuisance or there's a big drawdown, then really identify it, maybe trim it or exit it completely, maintain decent amount of liquidity. So I think these are some of the metrics you would look at from a risk standpoint.
Yeah, and I think this is it's applicable to retail investors as well, right? Diversify across stocks, across sectors, keep some liquidity, make sure you rebalance. I think these are the top few things that even we would suggest to our retail clients. So yeah, really good points. I like that. Okay, so moving into the next segment, which is one of my favorite segments to talk about. Because we're going to talk about some trends and where you see the market is going in the future.
Sure.
So I wanted to begin with one of my favorite categories, which is the large caps, because they're kind of tagged like this, like safer bet, and these are large companies जिनका मतलब growth अभी हो चुका है. Is that still the prevalent kind of description around it, or is the trend changing? Where do you see this going in the next 5 years, let's say?
See, I think one is like even large caps, they're an entire spectrum.
Yes.
Like you have companies like Dixon or even Trent, even Zomato, which is one end of the growth spectrum. And then you have other companies which are obviously sort of at the other end of the growth spectrum. So I think one is to identify which part of that growth and valuation spectrum you want to be a part of. And the other thing is, from a safety standpoint, yes, I mean, IT, pharma, some of these are sectors which don't usually correct a lot or not very volatile. So yeah, I mean, you can certainly move to them when you think markets are uncertain. But a lot of the, I think even big money, like a lot of the large mid caps, or even some of the smaller large caps, like there's a lot of money to be made there also, which are growing at reasonable pace.
Yeah.
So I think, in fact, if you see our portfolios there is a large skew towards maybe some of the mid cap side of things. And we think that there's enough growth and liquidity there. Because now what has happened is the liquidity, number of participants in the markets have gone up quite a bit. So there's a lot of concurrent liquidity available, which may not have been the case 5 years ago.
Yeah.
So I think one reason why people went to large caps is the liquidity.
Yeah.
And second is lesser volatility. But over a period of time, if liquidity is taken care of, then value creation happens where there's earnings growth and reasonable valuations.
Yeah.
So we tend to go in those pockets where we find companies. So that could be a spectrum all the way from large caps and even to some of the mid caps and some large select small caps as well.
You mentioned the volatility. Now, we've experienced volatility for a while. Where do you see this going? Do you see the market continue to be volatile in the next, maybe, 1 year to 5 years? Where do you see it going?
So I think some of the volatility started post-September.
Yeah.
And yeah, I think markets have been range bound in that time period. I think two factors. One is that for the first 9 months, we've not seen much earnings growth at a economy or system level. And the second thing is sort of people are fearful about what Trump is likely to do.
Yeah.
And bond yields went to 4.9% in the US.
Yeah.
So the US 10-year bond yield is it's like
Big factor.
it's a big barometer. So I think these two things have spooked the markets a little bit. I think people want to see some signs of will growth come back and all of that. So that let's see what the budget does. But our view is that in the next 2 to 3 quarters the growth should start coming back.
Got it.
Because we are in a positive sort of gross capital formation cycle. So next 3 to 5 years from a capex standpoint, or from an infrastructure standpoint, or from an like specific industries like electronics manufacturing, etc. Like we're seeing a lot of tailwinds. So we do think that should come back. And so yes, I mean there is some intermittent volatility, but I think over the next 6 to 12 months maybe that should subside.
Nice. And what do you think the next wave of, let's say, themes or sectors, do you think the next wave is going to kind of ride on?
So I think one theme sort of seems to be electronics manufacturing. I think that's definitely going to be a big theme. So power transmission capex, that's a theme which is going to last for a period of time. And I think select opportunities on the renewable energy side. I think these are 3 areas where there's clear demand and visibility of growth. And that's likely to continue.
Nice. And now this is one of those, hook ideas, or just like one of those things that people talk about a lot because they think that this is what everybody wants to hear, or the new investors want to find out. A multi-bagger. They're like, multi-bagger dhoondna hai kahin se bhi.
Yeah.
Do you think there is a kind of a framework that one can follow to find the next multi-bagger, or is it just one of those things that you can't really tell?
So I think a lot of time multi-baggers are made in hindsight. I mean,
hindsight is 2020.
Yeah,
always.
yeah. So I think usually what happens is like, one is that if you're able to find a company which has either corrected a lot, where there's a lot of non-consensus, under ownership, and the earnings, like supposing if you model the earnings from the next 4 to 5 years perspective, and you add up those earnings and they equal to today's market cap, then maybe you're sitting on a potential multi-bagger. So that's usually how they start. And for a long period of time, multi-baggers don't do anything.
Yeah.
And then they start. So you have to be extraordinarily patient as well.
Yeah.
So, I mean, it could be a sunrise industry. It could be maybe something has really fallen, or maybe there is some management change happening. So a lot of these instances lead to multi-baggers. But I think it's difficult to pinpoint at the time you're buying them when that journey will evolve.
Yeah. And you mentioned the budget. What are you looking forward to in this budget, or what are you kind of, looking forward to after the budget for your potential investments and maybe for the economy?
So I hope that the budget doesn't come up with something completely unexpected on the negative side. As long as, even if there's nothing, even if it's a non-event budget,
it's all right.
It's better than sort of something which, where they try to do something completely earth-shaking.
Yeah.
The other thing is, obviously, I think even the central bank could be looking at signals from the finance ministry to signal growth. So I think that focus on growth, because I think that badly needs to come back.
Yeah.
So I think these are some of the things I'll watch out for.
And now that the US elections and inauguration and all of that is over, do you think the fact that now we know that Trump is now here to stay for the next few years, do you think that will bring a little bit of stability in the global markets, or do you think it's still volatile? I
think definitely one part of the volatility has played out. The other part of it, if he does something, we have to see what changes he brings about. I don't think that, like what he said in his election campaign, things will be as dramatic as that. So looks like maybe things could be better from here, because he's a deal maker at the end of the day, and I think he would want the American economy to fire up. Of course. So yeah, I think it should reduce, but again, it's anyone's guess.
Yeah, very true. Okay, going back a little bit, with over a decade in finance, what do you think has changed the most in terms of the landscape here? And what do you think will change the most in the next, let's say, decade?
So I think number of participants, and I think just the speed at which things move. So I think like earlier people used to say, like, you buy, hold, wait for value to unlock in 3 to 5 years. I think now that cycle, in many cases, it happens in 3 to 5 months.
Oh yeah.
So that pace, I think, has increased. So I think you have to be a lot more wired in, a lot more agile compared to maybe what you could afford 10 years ago.
Yeah.
So that's one thing. I think next 10 years what will happen is obviously the size of the markets are going to be much larger. You're going to have to be more on top of your game. And yeah, I mean, I don't know what roles machines will play. Yeah. But to me, it seems like there will be more high frequency trading companies. There will be more quant funds that sort of come in.
Yeah.
And so there will be a wider array of participants in the market.
And do you think that the whole trading versus long-term investing, now that you've said that, it's already shaped out a little bit, but do you think that there will be more focus on trading going forward and a little bit of kind of, with the whole AI and robo advisory and all of that, will that kind of push it in the direction of trading a little bit?
So I think it again depends on what time duration you define as trading and investing, because now even HFT is trading, even positional trades are trading, even sometimes even 6 months can be considered investing. So, but generally trading is more from I think to generate cash flow, and investing is more for wealth creation.
Got it.
So that's how I would sort of look at the two. But I think most people are out there to make money. So if you spot an opportunity,
you'll take it.
Where you make money and you think it's worth your capital and your time, then you should take it.
Yeah. And your opinion on the startup culture, because we've seen so many entrepreneurs recently. We've talked to so many founders, and we've seen this culture really grow in the country. Because now going into your basic, you do your engineering and then you kind of just get a job and then you stay there for the next 30-40 years is no longer the norm. People want to build their first startup when they're like 16 years old now. So what do you think about the startup culture, and how do you think it will shape the economy?
No, I think it's great that there is this sort of wave of innovation and entrepreneurship, and I think what has happened is over the last 10 years this has become a very formal sort of an asset class almost in itself, with a full ecosystem of investors and entrepreneurs and mentors and all of that. So it's a great ecosystem which has built up, and I'm sure a lot of like even for example in America this has been happening for 40-50 years, which is why a lot of great companies have come. So I'm sure like this will produce some outstanding startups and companies from India. I think the only one thing though is that everyone is very focused on trying to create money too quickly, and even when people don't necessarily have the maturity they may not even understand the industry, but they want to disrupt it. So I think some entrepreneurs said that if you don't spend about 10-12 years in an industry,
you don't know how to disrupt it,
and you're talking about disrupting it, then what are you saying? So I think that kind of holds true. Like you really, you should know your industry very well,
100%,
and then maybe disrupt it. I think.
Yeah, because if you don't even know what the status quo is, what are you disrupting?
Yeah.
Nice. So we ask everybody this question. This is something that is completely personal, but since we talk about personal finance, how do you manage your own money? So,
most of my money is actually allocated in different funds.
Duh.
Yeah, no, I think for me it's also because of a regulatory from a regulatory standpoint.
Yes.
Yeah, so I invest. So it's a little boring. It's a bit of a boring answer, but yeah, from time to time, if I find something which is very interesting, and which is outside, which is within an investable universe, then I do invest in certain standalone companies as well.
Nice. So you know what the funny thing is, we love boring portfolios because in the long term and kind of when you look back, those are the ones that actually generate wealth in the future. So all these get rich quick schemes really don't work. So we always appreciate a boring answer. We like that. Moving on to a little bit of a wrapping up on the conversation. I wanted to check with you because your stock market journey has spanned, like we said, over a decade. What would be one guiding principle that has, really made you stick to your journey and that has really inspired you and kept you on this path?
So I think for me, it's sort of been a focus on growth. And so from an investing standpoint, focusing on growth companies, and from a personal standpoint, focusing on personal growth, where I'm learning every day and maybe increasing my understanding of management techniques or how to invest or the opportunities I'm addressing. So
Nice.
I think if you're in that mindset, I think over 10-15 years,
Yeah.
it definitely takes you somewhere.
Nice. So would you suggest somebody who kind of wants to walk this path,
Yeah.
would you tell them to keep learning, keep reading something new every day?
I think you can keep reading something every day and keep learning something new, but I think you should also follow up with your learning, because if you just learn something
Yeah.
and you move on to say like some new other learning tomorrow and you don't follow up with it, then
There's no point.
then it sort of is just more of an intellectual sort of entertainment for you.
Correct.
So following up, like if you find something insightful, then actually implement it.
Yeah.
I think that makes a difference.
Nice. I like that. Let's say a 21, 22-year-old kind of came up to you and asked you they want to start their investment journey. How do they begin? Let's say 3 steps.
So I would first ask them that, do you want to be a full-time investor or you want to be a part-time investor?
Okay.
If you want to be a full-time investor, I would strongly suggest them to either intern or to work at an equities firm, which is either doing sell-side research or buy-side research, or depending wherever they can get their hand in. Because I think having early mentorship is very important. Like otherwise you can be lost in the wilderness.
Oh, completely.
Like
It's
right
such
now, last 3-4 years, the cycle has been kind to people, but
very.
but it obviously turns at some point.
Yeah.
So you need mentors who can guide you through that.
Yeah.
So that is one thing I would recommend. And if you're a part-time investor, then I would say that maybe you see what some of the bigger guys are doing, and depending if there is a sector that you understand, evaluate companies there, and just generally see like how different stocks are doing, what are the relative valuations, and get a sense of that.
Nice. And what about somebody who, let's say, has no idea about the stock market, has never, never been educated in the field,
Yeah.
but they want to get into this and start investing? How do they begin?
So, again, you can, there are a lot of courses online that you can take from seasoned investors. I think a lot of that is available. What you can do is you can take one stock and you can read the annual reports and look at that a little more deeply. Nowadays, there are also advisory platforms available online. So you can pay a minimal sort of a research, like a minimal subscription fee, get access to some research, see why they're doing what they're doing. If you're a bigger investor, then you can invest in a PMS kind of a platform. So it depends really on sort of what your goals are and what your situation is.
Yeah.
And then accordingly you sort of act.
I like that. Guys, pick up any annual report you have access to and just start. I like that a lot. Where do you think Motilal Oswal is going now in the next 5 years? What is the vision of the company? And what should we be excited about?
So see, I think the company is going to be part of, I think, almost every segment of capital markets. And every segment within the company is sort of going through a huge growth phase at the moment. Whether it is a retail broking, whether it is asset management, wealth management, investment banking, you name it. So I think the opportunity is quite substantial in the next 3 to 5 years. And it seems like, we have all the levers in place to sort of take advantage of this growth.
Nice.
So it should get somewhere, I think.
I'm excited. I'm excited to see where all of this goes.
Yeah.
And we're obviously following where you're going, and we're excited to see what that kind of leads us to. Thank you so much, Vaibhav, for having this conversation with us.
No, thank you, Sayali, and pleasure.
It was such an insightful one. I'm sure that our listeners and our watchers will have a lot to learn from this.
Thank you so much. My pleasure.
Thank you.
Yeah.
Thank you so much, everyone. Don't forget to like, share, and subscribe to our channel. We'll see you in the next one.